So the way our live streams work is if you're first into the chat, then, we answer the questions that come in the order that they're asked in. And Erica is a front runner. She likes to be into the chat right out of the gate. Can you see my screen?
Looks good, Dean.
Okay.
Yep.
So 324. So capital asset pricing model is used. Let me see if I can move the chat over. There we go. Now I got my chat where I wanted to do it. Okay, Cynthia, after we get done with Erica, we rotate. So one question and then we go to the next person, right? So, so just put it in there and then we'll go find it. Capital asset pricing model is used to determine the required rate of return. You must be our expected rate of return. So the simple idea of this is that nobody's going to play or hazard their capital if they can't do better than the risk-free rate of return. So the risk-free rate of return is whatever we assume it is. So if we assume a higher risk-free rate of return, well, then we're going to have to be compensated more. In fact, the Fed has been raising interest rates, and as they raise interest rates on the risk-free rate of return, it doesn't have to be a T-bills, whatever we assume. But
Dean, your internet is kind of goofing a little bit.
I'll tell you what, I got kicked off during the live stream, so I'm not surprised. I've been having issues all day long. So if for some reason I disappear, we will do it again. But
yeah, I'll just take a coaching call. It's fine, Dean. No worries.
No, you can't. They're not fungible, not fungible. Anyways, so the risk-free rate of return is whatever we assume it to be for doing the math. But in general, you're kind of familiar a little bit already with this expected or required rate of return. I'm oversimplifying this substantially. But if, for example, we have a market return of 10%, and I'm just making that up, and we have a investment, a security with a beta of 1.5, we would expect or have the expectation that we would get a 15% return. That would be our required rate of return, our expected rate of return. And again, if we got more than that, the excess return would be alpha, and the alpha could be positive or the alpha could be negative in terms of what we're doing here, right? Now, that's an oversimplification of it, but we are going to compare that to the market. All right, so let's add some math to it. Now, mainly is, do you recognize the inputs and the outputs on the capital asset pricing model? So here we go. So the risk-free rate of return is what we get for not hazarding our capital, right? So if I tell you, for example, a risk-free rate of return is 4%, I say, well, that's what we would have got with not hazarding our capital. So we're probably going to expect to get something better than that. And let's see, participants. So here we have a risk-free rate of return for 4%. The market return is 12. So we could have got 4% without risking our capital. So it kind of makes sense here that we're saying of that market return of 12, really we got 8% because, we could have got 4 without risking our capital. The beta is a 0.8. So this is less volatile than the market as a whole. Now that's important because that means we're going to make less money and we're going to lose less money. So if the market goes down 10, we expect ours to go down 8 instead of 10. Market goes up 10, we expect 8. So this is a beta of less than the market. Now, again, these are the inputs. I wouldn't worry about, can you calculate this math? But if we take our 4% risk-free rate of return, we take our market return. The reason we're minusing 4, remember, is because that's what we could have got without hazarding our capital. Now, in terms of math, order of operations, we always do the parentheses first. And so we take 12% minus 4%, and we times it by the beta, and that's where this number is coming from. That is the market return minus the risk-free rate of return times the beta. And then 4%, remember, is that risk-free rate of return. So we would require a rate of return of 10.4. So if we get more than 10.4, we're going to be happy. If we get less than 10.4, we're not going to be so happy. Now, on the test, sometimes they'll refer to that as the expected rate of return, the expected rate of return. Now, again, the Sharpe ratio comes into fact here when we're talking about the modern portfolio theory. We're trying to design portfolios that can, be on what we call the efficient frontier. So let me just show you that. Yeah, it looks like, okay, let me get rid of that. Anyways, the Sharpe ratio is how much risk did we take to get the reward? So I use the example, Erica, of, you give me $1 million, you give Oscar $1 million, and you say, Dean, Oscar, I'm having a beauty contest. And at the end of the year, I'm going to see who has more money. And whoever makes me the most money from their portfolio, I'm going to give them, Erica says, all the money. So Oscar and I are in a contest. We're both going to design a portfolio with $1 million. And whoever gives Erica the greatest return is the winner. And we come back a year later to Erica, and damn, we have the same return. So Erica says, well, gee, I'm not quite sure what to do now. I thought there'd be a clear winner, but you both got me 15%. And so, man, I don't know what to do. It looks like it's a tie. I say, Erica, it is not a tie. It is not a tie. I have a higher Sharpe ratio. I have a higher Sharpe ratio. What that means is I got the return, the same return as Oscar, but I took less risk to do so. So the only test question is that a higher Sharpe ratio is better, because that means you're getting a higher return while taking less risk. So that's the Sharpe user. It's used to measure risk and return. All right, I talked about CAPM. It looks like both you and Oscar want to talk about internal rate of return. There's not a dividend payout model. There's a dividend discount model. So, discounted cash flow is used when I'm going to be looking at a series of income streams that I'm going to get in the future. If it's a bond, I'm going to be getting a coupon payment every 6 months. If it's a stock that pays a dividend, I'm going to get a quarterly. And the premise of discounted cash flow is that the earlier money, this is the time value money, is always more valuable than the later cash flows. For example, if it's a bond payment, it's an 8% bond. And I'm going to get 8% is $80 per bond, 2 payments of $40. The $40 payment 6 months from today is worth more than the $40 payment 10 years from today. And what I want to do in discounted cash flow is come up with what I think would be a fair price for the future cash flows, the future income streams. So that's what discounted cash flow is all about. It's about taking that cash flow that we're going to get in the future and discounting it to come up with what we think is a good deal today. And then based on that, decide if we're, a value investor, whether it's a good value or not. I always use Mr. Buffett as an example. Mr. Buffett says he likes stocks that pay dividends because what he likes to do is just discounted cash flow on the dividends and see what he thinks is a fair price for the stock today based on the future expectations of getting that dividend income stream. So Erica, when that is applied to a stock, it's called dividend discount model. So discounted cash flow is applied to a stock is called the dividend discount model. Now, the assumption of the dividend discount model is the dividend remains unchanged. We also have what's called the dividend growth model. In the dividend growth model, we make the assumption that the dividend is going to grow. And the test question about that is it justifies paying a higher price for the stock. Test question, can we assign or use the dividend growth model for a preferred stock? Can we use it for a preferred stock? The dividend growth model? Yes or no? Yes or no? Can we use it for a stock or not? No, we can't, right? Because the dividend doesn't change. The dividend isn't change. All right, so we'll come back. We'll do some efficient market hypothesis. Cynthia's next in the queue. So I'll go get the Kaplan Q Bank. We'll do those. Then Oscar, I'll look at yours and we'll look at internal rate of return, efficient market hypothesis. It looks like common stock. I'm not sure. Yeah, common stock. You can use the dividend growth model. Indeed. Wendy, straight line amortization and tax basis. That's usually for muni bond bought at a premium. So let's get the Kaplan Q Bank. We'll get those knocked out and then we'll do whatever else. Let's see. I'm going to go grab the Kaplan Q Bank. Is that, are those Cynthia QIDs from series 7 or series, what exam is that from?
Series 17.
Okay, thank you. All right, let me get this thing queued up here. I know that's got to be aggravating for you guys when your test prep vendor does load the, you're going to do your online work and, it's shut down doesn't work. Cynthia, I'm not so good at navigating around. So could you just read me that first QID number and I'll put it in here and I'll put it on the shared screen.
Sure. It's 126 5278.
5278. Okay, a technical analyst. So I would be prepared for questions that ask you to distinguish between technical analysis. Oh, I'm sorry, I got to put it on a shared screen. Okay, let's go back and find you guys now.
And I was able to get it down to a 50-50, but
Well,
I got it between A and B.
Yeah, 50-50 is always good. Okay, hold on, I got to find okay, there's that. I got to find you guys. What did I do with you guys? Stop screen sharing. Okay, there you guys are. Okay. Can you guys see my screen?
Yes.
Okay.
Technical analysis.
Yeah, so technical analysis on Series 7 is least likely to consider which of the following when selecting securities. Corporate earnings is fundamental analysis. So when we're looking at the economy and the industry and a stock, financial statements, that's going to be called fundamental analysis. We are concerned with what's called the short interest ratio because, Cynthia, there's what's called short interest theory. It's counterintuitive, but it says that the short interest, people who are short the stock, can accelerate bullish trends because they got to buy to cover. And that is a technical trading theory. So if I'm a technical guy, you say, Dean, why are you so excited about the stock? I say, man, have you seen the short interest? Have you seen how many people are short the GameStop? And all those people who are short are going to get squeezed. And then they're going to have to buy to cover, and that's going to cause the stock to go up. Please note, I didn't say anything about products and services or earnings or the economy, none of that. The advanced decline rate, I like that as a technical indicator. I'm trying to confirm either a bullish or a bearish trend. It's all about confirmation or non-confirmation. And if we have 10 advances to 1 decline, that means I can feel pretty good about the advance, the bullish trend. If I have 10 declines for 1 advance, I can be more confident in confirmation of a bearish trend. If the advance decline is a tie, that means non-confirmation. Who cares if anything Dean just said, except it's a technical discussion. I'm not discussing, Costco and how many memberships they got and how much stuff they sold. I'm simply talking about the market as a whole and what we call breadth of market. Trend lines, very important. So remember, trend lines are about charts. And as I said, we want to be able to confirm either an upward trend or a downward trend. And that's certainly a technical theory. Now, the other thing I would add to this, Cynthia, on a chart, you should be familiar with the support line and the resistance line. The support line in the chart is the bottom line. And the resistance line is the top line. And again, we don't believe in buying the stock when it's within this trading range. This is price going vertical. So this is price going this way. And this is time going this way. And so what we're looking for, as we mentioned here, is we're looking for a breakthrough, either a breakthrough the resistance line or break through the support line. As a technical practitioner, I don't really care, Cynthia. I just care that it breaks through. So, you know, the test question here would be, as a technical practitioner, I would put a buy stop here to go long, and I would put a sell stop here to go short. And again, I wouldn't do anything while it's stuck within the trading range. Now, the other charting pattern you're held accountable for here is what's called a head and shoulders pattern. And so I would know a head and shoulders pattern. It's the only time the charts are going to look exactly like they should look. And that would be a signal of a reversal. That, Cynthia, is the end of the bull and the beginning of the bear. And then an inverted head and shoulders would be the end of the bull and end of the bear, beginning of the bull. Okay, so I don't particularly like this question, but I do think you should be able to contrast technical analysis with fundamental analysis. What was your other QID? What was the?
Yeah, thank you so much, Dean. The next one was 133
133
6719.
6719. Okay. Okay, so let's see what that one is. A credit calendar spread. So what you should know here is that in a credit spread, you're going to have more money in than out. More money in than out. So to figure this out, you've got to know three things. When they're asking about spreads missing premiums, I suggest taking a note. You should know that longer term option contracts always have greater premiums. Longer term option contracts always have greater premiums. You know, the longer I give you to be right, the more likely it is I'm going to charge you accordingly. So, you know, if you want to be able to buy the stock or sell the stock for a longer term, that's going to cost you more money. And then credit, remember, I'm the guy taking the money. The second thing you got to know about missing premiums is that lower strike call contracts always have greater premiums. And the third thing you got to know is higher strike put contracts always have greater premiums. Now, if you know that, then we say, okay, if longer term option contracts have a greater premium, I'm going to have to sell the distant expiration to have more money in than out. And so I'm going to buy the near expiration and I'm going to sell the distant expiration. Now, Cynthia, there are questions on the exam where I ask you to determine debit or credit spreads with missing premiums. This is a hellacious one. I think it'd more often be either a credit call spread or credit put spread or debit put spread or debit call spread with missing premiums. And again, the way you do it is by knowing which premium, which option contract has the greater premium. As I just said, the key to this question is the longer term has the distant premium. And so 1 and 4. All right. Does anybody else have a QID from the Series 7 Kaplan QBank? All right. Did anybody have another QID from a different Kaplan exam? So I got the QBank open. Is there anybody that has a Kaplan QID from a different series they'd like to discuss? If so, now is your chance to say so. If not, you know,
Can you just fire up some questions from the 6016?
I cannot. That's not what the live stream is for. And we got to answer other people's questions. But, you know, if you win your coaching.
Dean, this is Oscar. Do you still have the question I emailed you?
Yeah, let me grab that for you.
Yeah, thank you.
Let me see. Let me get out of here. Stop share. And let me go to a smaller screen so I can grab my email. I'm closing the Kaplan QBank. Last call for Kaplan QBank. It is now closed. Okay, and let me go find that question. Oscar, and then we'll put it up here. I was just to talk about Jeremy Solomon, and you know, I disclosed I like him because he sent me referrals. So he just sent me a referral. Nice guy. Okay, let's find Oscar. Where are you at, Oscar? There's Oscar. And here's his question. Okay, let me now go back to you guys. Okay, can you guys see my screen?
Yes.
Yeah, it's faint, Dean.
Well, what can I do? Tell you, we can't, where, let me see if I can blow it up. I'll read it to you though. Whoa. Better, worse? Can you guys still see it?
A little better.
Okay, well, I'll read it to you. When an investment advisor representative, when is an investment advisor representative required to make disclosure to a customer? When are they required to make disclosure to a customer? Now, I think, Oscar, this one was kind of tough, and it was so tough, Oscar, that I didn't even make a video of it because I thought, man, this one's kind of, a gotcha question to a certain extent. So as you can see here, Oscar had 1, 2, and 3. Okay, so let's look at each of these. When an investment advisor rep is preparing a recommendation, uses research provided by a third party with whom the IAR is not affiliated. Now, Oscar, my guess is here that you maybe thought this said something different than it did. The violation would be if I'm actually using this as my own and, putting my name on this research report, even though it's a third party research report, well, that would be a violation. But if I'm just using, I subscribe to Value Line, for example, I subscribe to various research services, and I'm using those backstage, I don't need to disclose that to you. I don't, I say, listen, I have 20 different research things I subscribe to, and, that's where I get some of my ideas. That need not be disclosed. Now, remember, that's different than if this is, I'm holding it out as being my own product, my own research product. So that's why 1 is not a part of the answer. 2, now you got 2. When an IRR makes a specific insurance policy as part of the overall plan, you receive a commission. That's very testable. And you did get this right, Oscar. So I say, hey, listen, as your investment advisor representative, you need insurance. And you say, do you know where I can get some insurance? I say, well, as a matter of fact, I do. I'm also an insurance agent. I literally, Oscar, had a guy who had hats behind his desk. One said insurance agent, one said, stockbroker, one said, and every time he changed his hat, say, okay, you want to talk to an insurance agent? I'll be right back. And he turned his chair around, put on his insurance hat, and talk to the customer. So it looks like you got 2. You got 2. 3, when transactions recommended to a specific client are inconsistent with those for other clients with objectives that are similar to the particular client. No. I mean, there could be equally suitable ideas. This one is close. If this would have said, when your personal transactions to your client are inconsistent, then you would have to disclose, not other customers doing equally suitable things, right? So that's why 3 is not a part of this answer. Again, very close to that 1 thing, right? It's going to be if my personal transactions are different than your transactions. I say, Oscar, yeah, my advice is inconsistent with what I'm telling you because you're a young man and I'm an old man. You can be more aggressive than I can. So yes, we're doing different things. So that's when 3 would be disclosed, not when it's customers that are doing different things that are equally suitable, keyword, equally suitable. 4, when transactions recommended to the client, there we go, are inconsistent with those of the rep, and that needs to be disclosed. That's okay, but then I better have some articulation about why, right? The obvious thing would be my investment objectives are different. All right, any question on that one, Oscar? That was a tough one. That was a tough one.
No, I appreciate it. It clarifies a little bit more for me.
Yeah, by the way, I don't think your miss is bad because if I could have twisted 1 just a little bit, it would have been a correct answer. And I could have twisted 3 just a little bit, and it would have been a correct answer. So I would chalk this one up to Kaplan jerks are bigger jerks than the real jerks. So, I consider that to be a little bit of a gotcha question. All right, let's see what else we got going on here. We got, that was Oscars. I'm Wendy. I'm not sure what you asked me about, which is highly testable. Oh, the saucer. I haven't had anybody tell me they've seen the saucer on that. Technical analysis is not highly testable, but I'll tell you what I'll do, Wendy. I made a video on technical analysis and I will put it in this replay at 2749. it took me forever to make it. And people say, why don't you have a technical analysis thing? I said, well, because I think there's other things more important. So if you tell me that that you are going to, you failed your exam because of that. Yeah, I'm a little bit of a stinker tonight, but listen, I've been tutoring all day. I've been teaching all day. So, I came very close to just canceling this thing. So time rate of return and dollar rate of return are just about how you would use it for mutual funds, right? So it's not it's an explanation. It would be whether you use it for a separate account, your customer's portfolio, or whether you use it for a mutual fund. And time rate of return would be used for the mutual fund. All right, let's see. Straight line amortization. So Wendy, let me get a whiteboard here. On straight line amortization upward, you just need to know that on the test it needs to be done. So, here is a bond and we buy it originally issue at a discount. And here's what this looks like. And, maybe I buy this OID bond for 500 and it matures at 1,000. And let's say it's 10 years to maturity. And, what you have to be able to do on the test is just know that what we're going to do here is we're going to take the $500, do straight line amortization upward called accretion. Somebody getting locked out of the classroom. Anyways, 500 divided by 10. And you would tell me that's $50. And the test question is you have to do straight line amortization upward called accretion. Test question, do you owe taxes on that $50? So your customer buys an original issue discount bond, AKA a zero, for $500 with 10 years to maturity. I'm not going to make you do the accretion, but does your customer, chat is open, does your customer owe taxes on that? Yes or no? No, the answer is yes, you do owe taxes on it. That kind of sucks. There's an imputed interest you're receiving and you owe taxes on it. What do we call that? Paying taxes on things you're not actually receiving. That on income. Now, the only exception to that, Wendy, would be if this was a muni bond. If this was a muni bond, zero OID that we're buying from a municipality, that imputed interest would be part of our tax-free return. But on that, you owe taxes, so it kind of sucks. You're paying taxes on money you're not actually receiving. Now, the one I think you're more likely to see, it's about 50% probability, is doing this downward for a muni bond purchased at a premium. So when you buy a muni bond at a premium, you have to do this downward, and this is very much more a testable scenario. So your client buys a muni bond for $1,200, and now we're going to be going the other direction. And this is testable. This is practical application. So now we're going to say, okay, well, we're going to go here and you're losing out $200. You're not allowed to decide when you buy a muni bond when you're going to realize that loss. The IRS says we want you to take that loss in little itty bitty hits along the way. And so when you buy a muni bond at a premium, you have to do straight line amortization downward. And so test question number 1 is how much must we decrete each year? And we would say that we're going to decrete $20 a year. So we're going to adjust our cost base each year. So year 1, we're going to claim that loss. And we're going to say our cost basis is $1,180. In year 2, we're going to say our cost base is $1,160. So test question number 1, your customer buys a muni bond for $1,200 with 10 years to maturity. What is the amount that needs to be amortized in terms of adjusting the cost base? You say 20. Now it says you've held the bond for 6 years. That's test question number 2. So you've held the bond for 6 years. And they say, what is your adjusted cost base? And you say, okay, well, 6 times 20 I should have written this down by $120. Right, so I'm going to take my cost base here at 1,200. I'm going to minus from that the 120, and my adjusted cost base is 108. You know, again, that 120 is the 6 times 20. And then they say after holding it for 6 years, you sell it for 110. And so then if you miss this completely, Wendy, you say, okay, well, I bought it for 1,200, I sell it for 110. I lost $100. And actually the answer to this question on the exam is this is a $20 gain. So let's review. The question was, should you worry about amortization? And I said you should not worry about amortization upward. You know, you just need to know that it needs to be done and is taxable. Should you worry about amortization downward? 50% probability that you're going to have to do that. And so when you buy a muni bond at a premium, you have to adjust your cost base downward. You got to take it in literal itty bitty hits each year. You don't get to take it in one fell swoop whenever you'd like. So in this example, your customer bought a muni bond for 120, 1,200 with 10 years to maturity. How much needs to be created each year? We say 20. After holding it for 6 years, what's the adjusted cost base? We said, well, 6 times 20, we have amortized downward 120. Our adjusted cost base is 108. Your customer sells it for 110. What is the gain or loss? And you say a $20 gain. And that is very much a testable scenario. All right, let's see our chat. All right, let's go back and get the, let me go back and get the efficient market hypothesis, and we'll knock that out. Efficient market hypothesis. I think the easiest way on the efficient market hypothesis to get that right is to actually start with either side of it. What I mean by either side, I'll show you here in just a minute, is to start on either side of it and then say, okay, well, nothing works with the strong form and something does work with the weak form, and you can kind of go about it that way. Now, let me find it here. Calls and puts. We don't want calls and puts. Here we go. Okay, let me find you guys. There's you guys. There's me. Can you guys see my slide?
Yeah.
Yeah, I can see it, Dean.
All right. So hypothesis isn't truth. It's just a way of explaining things. And the more a theory can explain.
A hypothesis is
She thought I was talking to her, these damn machines. Yeah. Anyways, EMH, not MPH. And this is 3649. Okay. So, you know, customer says, Dean, I just think it's a waste of time and resources to try and beat the market. You know, I'm willing to accept a market-based return. Now, hypothesis, like theory, isn't truth. It's just a way of explaining things. And the more the theory can explain, the better that theory is. Right. So, you know, my brother and I get in arguments all the time. I say, Chris, you have a hypothesis. I have a hypothesis. For all we know, we both could be wrong. I kind of like my hypothesis better because it explains more. But at the end of the day, it's just a hypothesis. And there are 3 forms, and you will get a couple test questions on 65 and 66 about the efficient market hypothesis. You know, the can't beat the market, just throw the darts is the strongest form. You know, this is the form where, you know, monkeys throw darts at the Wall Street Journal, and when it hits a stock, we buy the stock, and then, you know, the monkeys beat the professionals, you know, more often than not. Weak form is based on information that everyone knows. And so that would be technical analysis. And so efficient market hypothesis says technical analysis is a waste of time because everybody has equal access to that information. Strong form or semi-strong says there's information available with some effort. So that means not everybody is doing the homework. And so some things might work. And strong form says nothing works. Now, here I think is a perfect version of the test question. Here is a perfect version of what you're going to be asked on the test. They're going to ask you on the weak form, what doesn't work? And you're on the test going to say technical analysis. If they ask you what will work, you say fundamental analysis and insider information. If they ask you about semi-strong on the test, you say technical and fundamental won't work. Insider information does. On strong form, you say technical and fundamental, insider information, nothing works. In its strongest form, this is called random walk. Now, that doesn't mean we're not going to make a recommendation to somebody. That just means, maybe we'll recommend to them an index fund, for example, is what we might recommend to them. So again, that is very, very testable. All right, let me see if I can find us. Screen sharing has stopped. I don't know why it stopped. Let's try and get screen sharing back. All right. Dun, 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 dun. I'm just trying to find the internal rate of return slides. Valuation. Here we go. Can you see my slides?
Yes.
So discounted cash flow. So as we said, you can use discounted cash flow to value debt securities, and you can also use it to value stocks. When we apply to stocks, remember it is testable. No, when applied to stocks, this is called dividend discount model or dividend growth model, depending on what situation we're looking at. The bonds price always reflects a yield equal to the current market interest rates for comparable risk. In other words, we're going to be comparing not apples to oranges, but, apples to apples. As we said, we take the income payments scheduled to be received over a given future period, and we adjust it for the time value of money. As we said, the earlier payments are worth money. Money in the near future or in the present is always worth more than the money in the future. We take the future principal repayment and we discount it to get present value. Now, based on that present value is how we decide on whether it's going to be a good deal or not so good deal based on having done the math. We're not going to ask you to do this math on the test. We're just going to ask you to recognize it. So the value of the bond is the present value is future cash flow, right? So that's why we're doing the math. The higher the discounted cash flow, the higher the DCF, the higher the value of the bond. The cash flow analysis on mortgage, we don't have set payments in a mortgage because people refinance, they move. And so on mortgages, we use whatever the average maturities are. We said with equities, it's going to be called the dividend discount model. And remember, stocks don't mature. So that payment cash flow goes on and on and on and on. And there's an example of a test question of that. And you can use anything you want to do the discounted cash flow. I have real estate friends who use, T-bill or T-note. You can use whatever you want to do. Actually, if you're going to do the math, I'm not going to make you do the math. I would just ask you, to recognize the math. And then on the internal rate of return, it's just what takes that future value to the present value. So on that one, Oscar, when we're asking you that, let's see if I can find that for you. We're just asking you whether or not it's a good deal or a bad deal based on whether it has positive net present value or it has negative net present value. So let me see if I can find that here. Here we go. All right, this will be the last thing we do tonight. Looks like it's a NASA night tonight. So rule of 72, you can actually do that, but here's the net present value in your question about internal rate of return. So net present value, we subtract the cost of the investment from the present value of the future returns. Positive net present value is always desirable. So let's say we're looking at a bond that's 940, and when we do the discounted cash flow, we come up with a present value of 990. Woohoo! So that means we have net present value. We have a positive number. So that means we should consider buying the bond, right? Because its cost is 940 and the future value of the income streams when discounted to a present value is 990. So we found a free lunch. Now, if the present value is 900 and then we're looking at the bond at 940, then we say, well, no, why would we do that? That doesn't make any economic sense. So again, I'm not going to make you do that, but I might ask you to recognize whether it's, the value is a good value or a bad value based on net present value. Internal rate of return. So here's our internal rate of return. That's the discount rate that brings the present value to zero, right? So we had if we were in a class, we do a $25,000 example. Now, as I said, this is the test question, Oscar. They ask you about a bond and they ask you the internal rate of return. And it's just the yield to maturity, right? So if you buy a bond for 900 and you're getting back 1,000, well, then that return is 8.5% that brings it to the 900. It's locked in, is the point. And I would expect a question about that as well. They say a yield to maturity on bond best reflects which of the following, and you would say the internal rate of return. I'm not opposed to making a flashcard. Again, you might have to use your calculator maybe once on the exam. So I would do that. Okay, so let me see the chat. I think we covered pretty much everything. Let me just go back and check our chat. Can you explain the Sharpe ratio? I did. Go over capital asset pricing model. We did. We talked a little bit about return. A mock question. We'll find that as a QID, or remind me, Erica, send me an email and maybe I'll dig up a QBank question that we can look at. But again, the mock question isn't, can you do the math? Callable bond math for 66. You don't have to do any calculations of yield to call. You just need to know that if it's a bond at a premium, that you have to quote yield to call. We did the QBank questions. We did discounted cash flow. We did dividend discount model. When they took care of straight line amortization. Remember, I told you it's bigger deal on the bond at a premium. I answered that question. Saucer, I said you're not going to see. And I'll pull a time weighted rate of return. The good question there is, you use that for a mutual fund because the money is coming in out of the fund all the time. Yeah, I think the Mayhammer goes overboard, Wendy. There's some people who love a cheap little Mayhammer. Ken Finn and I think it's a waste of time because both of us, we don't agree on a lot, but both Ken and I agree it's a waste of time. You're not going to have to know the hammer. What you're going to have to know is what we both tell you. Have recognition that you need to do it, not can you do it, that it needs to be done, and that it's taxable. And then you need to know the muni bond, the one I showed you, that is testable. That is testable. Okay. Efficient frontier, Erica, is a different thing. So just remind me in the next live stream, I don't know when your test date is, but the efficient frontier is where we create portfolios. I say, Eric, of all the portfolios I can create for you, what I'm trying to create is the portfolio that maximizes your return while minimizing your risk. And that's what's called the efficient frontier. It's the portfolio set that does that. And the closer we get to that, the more efficient our portfolio would be. So there's pictures. We can show you pictures of that as well. Oscar, you're going tomorrow. All right. We're all sending you good test vibes, Oscar. Circle back with your testing victory. Well, Cynthia, companies can borrow to pay dividends. It's not very prudent, but some Cynthia companies do borrow money to pay dividends. Larry Ellison of Oracle used to own 25%, Cynthia, of Oracle. Now he owns 42% using none of his own money. So what Oracle has been doing is buying back its own stock into the treasury, and Larry has not been selling his. And so his proportion ownership has gone up. So, people say, wow, they owe a lot of money. They got a lot of interest payments. But if Larry needs some money, he could have Oracle declare a $2 dividend. And your point, if there's no earnings, they would just borrow some money, more money. They're borrowing lots of money to pay that. So you can borrow money to pay the dividend. It's not a prudent thing to do, but companies do indeed do it. All right. Anybody got anything else? Okay. Well, remember.
I missed it. Did you cover the frontier and how I would recognize that as an answer choice?
I just did. I said the feasible set of the portfolios is called the efficient frontier, right? And again, it's the portfolio maximizes returns while minimizing risk. So the efficient frontier best describes, and you would say portfolios that maximize return, and that's called the feasible set of portfolios. So yeah, I did. And I told you, Erica, I'd show you a picture of it if you'd like. Not tonight, but some future point. It's a graph. And on the graph, it's called the northwest quadrant of where that takes place. So, all right. Anything else?
Thank you, Dean.
You're welcome. My pleasure. So again, there will be no live stream next Tuesday. And there will be no, on July 4th, we will be going dark. There'll be no live stream Q&A and no overtime, and then we'll be back the following Tuesday. So we got one more Tuesday together, and then we all can enjoy the holidays, July 4th. All right. Anything else?
Inch by inch.
Your test is a cinch. Yard by yard. Your test is
Hard.
hard. All right, guys. Talk to you later. Bye-bye.
Thank you, Dean.